Ladies and gentlemen, good day and welcome to Tata Chemicals Q2 FY21 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gavin Deesa from CDR India. Thank you, and over to you, sir.
Thank you. Good day, everyone, and thank you for joining us on Tata Chemicals Q2 and H1 FY21 earnings conference call. We have with us today Mr. R. Mukundan, the Managing Director, Mr. Zareel Langrana, the Executive Director, and Mr. John Mulhall, the Chief Financial Officer. Before we begin, I would like to mention that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. I now invite Mr. Mukundan to begin proceedings of the call.
Thanks, Gavin. Good morning to everyone, and thank you for joining us today. Hope everybody is safe and healthy. I'm joined by my colleague, Mr. Zareel Langrana, our Executive Director, and John Mulhall, CFO, on today's call. I will broadly give some outline to our quarterly performance and how we see the trend going forward is, especially in this situation we are in with COVID-19. And John will also highlight certain key financial highlights for the quarter. Firstly, I think we've had a very steady quarter. The performance has steadied a lot more from the previous quarter, and that has been on the back of the business environment becoming more stable. And with the business environment becoming more stable, the utilization levels have crept up, and as we exited the quarter, they are getting very close to near normal across all geographies. While we will have certain difficult moments to navigate through this period, I think we are now in a much better situation as the future in terms of the direction of the economic trends we see going forward. I will go through the discussion broadly in terms of the 4 verticals which I spoke to you last about, which is performance material, nutrition science, agri-science, and energy business. Energy business is still in a very nascent state, so will not make any major commentary on it except to say that the trend towards electrification, energy storage is a long-term trend. But in the short term, I think many of these plans are being pushed forward. So we will have to wait till a couple of more quarters for us to make any major point, except to say that our lithium battery recycling business has resumed, and in this quarter they did do some business, although minor, because those operations did start. Agri-science business is primarily done through our subsidiary Rallis, whose results have been released, and I will go to that little later. The 2 broad businesses which are within the standalone and within the unlisted subsidiaries of Tata Chemicals are the performance materials and nutrition science. As far as the performance material, it has broadly 2 branches of the business, which is soda ash and silica. The performance of Indian soda ash division is much better compared sequentially to the preceding quarter. Volumes were higher, and the demand from the market has been fairly steady. The key issue for us in this quarter was not market demand, but actually the capability to have a steady run of production, especially with very heavy rains which happened, which was because of the depression in Arabian Sea, which sort of impacted our operations for some time, and which has also been notified as a one-off, which we have taken in terms of certain impact on the business by about 11 odd crores. I think that came in this quarter in terms of the actual P&L impact. There are certain other material damages for which we have actually claimed from insurance, and those have not been accounted for, but we will account for them going forward. So clearly, the volumes have improved. The market demand is fine. There is a bit of softness in the realization which we saw in this quarter, but with the imposition of ADD, we think that softness is going to slowly give way to more steady pricing, and which will flow through in the coming quarters as we move forward. As far as the other big performer within this vertical, which is Tata Chemicals North America, it was aided with pickup in volumes, and not only have the domestic volumes improved, also export volumes have improved, and that trend is likely to continue going forward. And I think it augurs well for that business. As the volumes pick up, even the pricing power comes back to the business, and I think both of these put together would only couple this in a very positive trend, but it will play out, in my view, in the next 4 to 6 months, and we'll have to manage that period carefully, but it will be continuing improving trend. As far as Europe is concerned, it has been a steady quarter, and they have very marginal material moving out of the island of UK, and they are fairly protected in that way, and they continue to perform with minimal disruptions. On Africa, the volumes and realizations are marginally lower, and the realizations are lower mainly because the big market which got impacted on realization softness was Southeast Asia. But since towards the end of this quarter, realizations even in Southeast Asia have started to move up with lower availability of Chinese material, and I think that trend is likely to continue. So overall, on the soda ash piece, we probably have seen the worst of the period in terms of both realization and volume, and as these will trend positively, they will continue to move forward. As far as the contracting for next year is concerned, Zarir can add a bit more color to it. There is pressure from customers, which is to be expected because their businesses are also under pressure, but we will manage and navigate that with as best as we can. And if the economic environment turns better, the volume benefit which we will get will be much bigger than any of those sacrifices which may have to be made. And the costs are also trending down, so there could be some margin for us to play on that. As far as silica business is concerned, we continue to see good traction. And we've also had few OEMs of the tire OEMs which have come and audited our plant and have given a good response, and we should commence with trial orders in that business. That business is now beginning to gather steam, and as the plant operations move forward, I think we will also be expanding capacity from the current 10,000 ton capacity which we have there. Going to the second vertical, nutrition science, which is mainly salt, bicarb, and nutraceuticals. The performance continues to be strong, aided by the consumer demand. In UK again, British salt volumes are very stable. The bicarb operations in India were very good and consistent, and sales levels were maintained during the year. UK also had very consistent bicarb operations, and we will be increasing the sales mix of UK more towards bicarb and less towards soda ash going forward. And this should be margin accretive as the plant for bicarb is undergoing implementation and should be getting commissioned very soon. The nutraceutical business in Nellore, Mambatu, has had a very good traction. The growth has been good, actually better than our expectation, and the demand from companies also remains strong. On the agri vertical on Rallis, their commentary has already been received by you, but domestic seed business, domestic crop care and seed business performed well. Their international business had some challenges. We believe that things will improve going forward, and the capex plan and the new product portfolio improvement they have announced, that is well on track, and that should keep the growth momentum going forward. A quick word on our capex. As mentioned, we have decided to realign our capex in light of COVID, with focus on ramping up capacities on those where demand visibility is good, which is things like salt, bicarb, nutrition, and agri-science. For the rest, we have decided to calibrate scale up the capacity in a calibrated manner, and that trend remains even today. So overall, I would say business performance continues to improve steadily across geographies. Our efforts are mainly focused on improving the product mix right across all the geographies, and all the 4 verticals are shaping up well. And we are undertaking requisite steps to strengthen our balance sheet and cash position by rationalizing capex spend. In fact, the operational cash generation has been excellent, and the conversion ratios have been good, and John will speak about it. And we are well positioned to navigate not just this environment, but as we come out of this environment, come out much stronger than what we are today. With that, I now invite John to give his opening remarks.
Thanks, Mukund, and good morning, everyone. Before we get into the Q&A session, I'd just like to add some details, as Mukund said, to the results that we published last night. As I mentioned in the last call, the timing of annual dividends from Manasset and Malice was going to move into quarter two.
Sorry to interrupt you, John, sir.
Hello.
Please go ahead now.
Is that better?
Yes, sir.
Okay, good. Okay, thanks. Thanks, Mukund. So before we get into the Q&A, as I mentioned at the last results call, the timing of the annual dividends from Manasset and Malice was going to move into quarter two this year from quarter one last year, and that was the case. This led to non-operating income on standalone results being up 45 crores over last year. That's 64 crores on the last quarter. And the main drivers of this were the timing of dividend receipt, as mentioned earlier. Overall dividend receipts were up 46 crores over last year. We had reduced bank balance and mutual fund and fixed deposit interest. Our standalone cash at 1,970 crores is down 770 crores on last year. But remember, the ECB loan was repaid in October last year, which accounts for the majority of the difference. Our average returns from the mutual fund and fixed deposit market were also down markedly. In fact, the mutual fund yield in the quarter was down 150 basis points. And that led to bank and mutual fund income being down 19 crores over this quarter last year. Because we repaid the ECB loan, our bank interest was up, the bank interest expense was down 11 crores as well. So that was an improvement. On consolidation, our non-operational income is an expense of 15 crores this quarter, down from an income of 3 crores last year. Again, this just reflects the reduced fixed deposit and mutual fund income in Tata Chemicals Limited, with some offsets between interest income, provision releases, and some rental income as well. Operationally, as Mukund said earlier, while the reduction against last year remains, the rate of reduction has reduced this quarter compared to last quarter, although pressure does remain on pricing and on margins. For the standalone business, India soda ash sales were down only 3,000 tons in the quarter, compared to 44,000 tons in the first quarter. There was a reduced NSR with limited offset in manufacturing costs because we had the flood situation in Mittapur, affecting overall contribution from soda ash by about 49 crores. On the flip side, sales of salt were up 37,000 tons on last year, and we continue to see strong pull from that segment. Sales improved from our neutral business, up 23 crores, and from our silica business, up 6 crores over last year. These are all volume related. And while fixed cost management remains a priority across the piece, it's worth highlighting two charges in the quarter in India: 14 crores relating to gratuity resettlement as a one-time expense provision, and 11 crore material damage relating to the Mittapur floods, where necessarily we've taken the expense in the quarter before resolution of the insurance claim. Its claim is under process just now. Internationally, Kenya continues to suffer in Southeast Asia through market pricing and excess volume in that marketplace. So both NSR and freight costs have been impacted adversely in the quarter. Contribution is down against last year by about $2 million. In the UK, salt and soda ash operations were down in volume terms. Bicarbonate was slightly better, but better pricing in soda ash and improved energy costs across the piece, both in coke and gas, improved the contribution by about £1.5 million over last year. And even though we had a 25 crore one-off income last year, we still delivered a similar EBITDA number to last year, which the one-off income kind of hid the improvement this quarter over last year. The US did suffer from volume and pricing pressure and a manufacturing adverse in September through some unseasonably cold winter storm that came through in September. Overall, that probably impacted performance by around $10 million. But for the US, and I think it's important to make a point here, in quarter one, our sales volumes were 30% below last year. In quarter two, it's 17%. So year to date, we're just 22% below last year's sales performance. From a balance sheet perspective, our working capital has improved. Standalone working capital is 17 days in the quarter. That's a 5-day improvement over the first quarter. That's worth 32 crores to us in cash. Consolidated working capital is at 28 days, again a 9-day improvement. And that translates to 217 crores in operational working capital improvement. Our India cash position, both cash, mutual fund, and bank deposits, moved to 1,817 crores in September compared to 2,000 crores in June. It's a reduction of 182 crores, although CapEx in the quarter was 128 crores against 188 crores last year, mainly through our major projects in Mitterport. Year-to-date CapEx in India is 232 crores against 363 crores. Last year, just to remember, we had 694 crores as a full-year CapEx. On the consolidated basis, we had 3,039 crores of cash at the end of September, down by 219 crores against June, and that's after 315 crores of CapEx in the quarter. Year-to-date CapEx spend is 544 crores against 623 last year and 1,196 crores for the full year to March 20. With that, I'd draw the financial commentary to an end and then pass it back to the moderator to open up for questions. Thank you.
So should we open the line for Q&A, sir?
Yes, please.
Sure. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi sir. So my question is regarding US business. So we have seen a decent performance in US domestic sales of solar. However, export is still a laggard. So can you please discuss more about the export business of US business? Which market of export is not doing well? So we would like to know about that.
Zari, do you want to address that?
Sure, let me take that. And thank you for that question. You're absolutely right. If you look at U.S. domestic sales, compared to the prior quarter, they're significantly up. In fact, they're even higher than the similar quarter last year. Export sales still need to recover. While it is about 70,000 tons more than quarter one of FY21, we still do have a ways to go before we get back to normalcy. Coming to your specific question about where U.S. exports take place, there are really two key markets. One is Latin America, which includes Mexico, and the second is Southeast Asia. Both these markets were fairly significantly affected in Q1. I think across both markets, demand is coming back, but at a much slower rate than the home markets of, let's say, North America or regions like India. In Southeast Asia, container demand glass is more or less back. The flat glass sector is still to pick up in most of the markets. In China, for example, flat glass is back on track, container is back on track. But in the key markets of Indonesia and Thailand, I believe that it might take a few months more before demand comes totally back. An encouraging sign is that there are new flat glass lines that are under commissioning and shall open up within the next 2 or 3 months in the markets of Malaysia and Vietnam. So the trend is certainly positive. In terms of timing, I think we probably need to be a little more patient. As far as LATAM is concerned, the largest market is Brazil. And as you might be aware, COVID cases in Brazil were among the top 3 in the world, leading to significant contraction in those markets. Those are also beginning to come back, albeit at a slightly slower pace than Southeast Asia. The western part of South America, Latin America, is almost back to where it should be. And Mexico demand is again coming back strongly, especially on container glass, which it manufactures and ships across the border to North America, to the United States. So long story short, I think a few more quarters before U.S. exports get back on track. Trends are very positive. We are not seeing any customers cancel or defer orders, but there's a slow natural progression before we get back to where U.S. exports used to be a year and a half from today.
Yeah. I think just to add to what Zarir said, I think the trend is continuing to be in the positive side, and as the volumes keep coming back in the next 2 quarters, the pricing power also will come back. So it is going to be a benefit of both volume and price moving up as both these two come in. But it's much better than before, but it's trending towards normalcy, which we had indicated even during the last call. Towards Q3, Q4, we should be getting back to where we were. Q1 of next year will have a huge base effect, so we should not consider that. But if we take quarter on quarter, I think we are trending to where it ought to be.
So can you discuss about the overall realization side in U.S. has seen overall a 5% decline in U.S. term, while Q2 and 10% YY. So what is going to be in a couple of quarters, what is the price scenario across U.S. and India? Can you discuss that?
Sorry, I couldn't
catch that at all.
Yeah, Sumant, your audio is breaking a bit.
Okay. So what I was talking about, the overall the USD realization of US business declined 10% YOY and 5% QOQ. So can you talk more about the price scenario going forward and for US and also for India also, Rajesh?
India is slightly different. Zarir can speak about it. I think the fact that the ADD has come in and that itself is going to lead to firming up prices, because that is very specific to Turkey and US. So I think that's a very different situation in India. So I think Indian prices they had come down a bit, but they will trend up, and they're already seeming to be trending up. So that's as far as US is concerned, it is pretty much a market mix and a customer mix story through the period as far as the domestic market is concerned. And next year on contracting, what I mentioned was there could be a bit of softness in pricing, but that softness in pricing should also get aided by the softness in the input costs. So overall, I don't think there's going to be a big issue on margins. Zarir, you want to add anything to that?
No. Let me start with India. You're absolutely right, Mukund. With the announcement of provisional anti-dumping duty on soda ash, I think it would be normal to expect that pricing would improve once the formal notification and gazettement of that duty comes through, which should be fairly soon. It's just a process issue. We are beginning certainly to see signs of that happening, but once the duty comes in, I believe the pace of that price improvement would improve. As far as North America is concerned, like buyers across the world, buyers are expecting price declines to take place and softness. That's their job. And while there might be some price sacrifice that producers might need to make, I think the relief on the input side and the cost side, whatever we are doing in terms of addressing our cost base in the US should keep margins where they are, if not a little better.
My last question regarding salt business, we have seen a 14% kind of improvement. So can you discuss about the key drivers for that, apart from the capacity expense?
We can't hear you. Can you repeat that
Your
question?
audio is slightly muffled if you are on a headset.
Was 14% YY. So can you discuss about what was the key reason for that, apart from the capacity expense?
Sorry?
Hello?
Sumit, I would request you to be a bit loud, please, as your audio is breaking, so we are unable to hear you clearly.
Okay. So I was talking about overall sales, salt business sales growth volume growth was 14%. So what was the key reason for that?
There is no key reason. We tend to be supplying to customers. We supply to all the brands, all the companies who want salt, bicarb, everything. So I think they will continue to get the product. And in terms of, I also told that in terms of prioritization of product mix, if the plant has a flexibility, whichever plant in UK and India, all these plants have a little bit of flexibility of flexing between soda ash and salt. While the consumer markets are doing well, so we flex them towards the salt business. That's about it.
Okay. Thank you so much.
I don't think you should underestimate the power of a brand and also the distribution strength that our key customer for salt has. So that's a contributing factor.
Okay, sir. Thank you.
Thank you. Before we move to the next question, we'd like to remind the participant to limit the question to 2 per participant. If time permits, you may join back to the question queue for any follow-up. Thank you. The next question is from the line of Abhijit Akela from IIFL. Please go ahead.
Yeah. Good morning, gentlemen. Thank you so much for taking my questions. I have a couple. First, on the specialty chemicals business. If you could please talk a little bit about both the nutraceuticals and the silica businesses in terms of where they stand exactly right now in terms of customer acquisition and volume scale up, and how we should expect these to trend over the next couple of years. Are there any financial targets that we should keep in mind in terms of say revenues over the next 2 to 3 years?
Yeah. So I would say between the two of them, I think we should be 3 digits this year. I think that is our first milestone which we want to do, and that is despite a very poor first quarter with these 2 plants were actually shut. So that's really our target and ambition to move. And clearly, the Mumbai plant, our aim is to at least exit this year with 75% utilization of the plant. So the average number may be lower, but exit it with about 70, which is a good exit point. We had targeted that to be about 60 to 70, but we have upped the number because of the strong demand. As far as silica business is concerned, both these businesses are going through their broad approval process from key customers. The nutraceutical plant needs approvals from the pharma and from the food companies. At least it is in the last leg of a couple of pharma companies clearing that factory for approval. That would bump up the demand immediately post that in terms of the deliveries. And as soon as we get close to about 80% utilization, we will be certainly kicking in expansion of that unit broadly to keep in line with the market demand, so that as the demand moves up, we have the next line of capacity coming on stream. As far as the silica is concerned, I think 2 of our key tire customers have already approved the plant, and we are awaiting the first initial orders to come in. And our intention is not to wait for the factory to fill up to 70-80%. We are going to be embarking on expansion shortly. We have just finished acquiring land nearby. The Tamil Nadu government has allotted the land. The process is just about finishing. As soon as that land is in our possession, I think we will embark on scale up of that plant from 10,000 ton to at least 5 times the capacity as a phase 1. And as far as Mambo to Nellore is concerned, nutraceutical, the step will be to double the capacity going forward from the current capacity to twice the number of capacity. And we have land and other elements already set in place to go 4 times the current capacity on the current site. The silica business was constrained with respect to land and utility, which is why we had to wait for the approvals to come through for the next expansion.
And so just a quick follow-up on that. If I am right, then the existing capacities that we have right now in these two businesses, the 565 crores that we've invested, that itself suffices to drive about 1,000 crores of revenues at peak. Is that correct?
Yeah, I think the figure of 500, the figure which you have, we have not invested the full money in the silica business. It's still, I think out of the 250 or 270 odd crores which we were to spend on that, we've only spent about 140 crores, including the land which was acquired. The balance will be spent when we expand the capacity. And I think that's the status on that. So we already have the approval to move forward, which is why we are moving forward. But we are not moving forward to 20,000, which was our initial plan. We've upped the number to 50,000 straight away in the first go itself. So which is why we had to acquire the land. So we'll come back with specifics, but it's going to be a little more than around 300, 350 there, which is what we will end up spending. As far as Nellore is concerned, we have already spent 250 odd crore. But the doubling of the capacity will be at a slightly lower cost because the utilities have been built for almost 2 times the capacity already. That will not be in place. So it should probably be at half the number which we spoke about as we move forward.
Okay, great, thank you. And my second question was just on the North America value addition plans that you had alluded to on the last call. If you could, highlight any specifics that we've sort of, moved forward with on that. Thank you.
The studies are over, Jeet, and I think what we are intending to do is to come towards end of this year to sort of give you specific plans on that. And clearly, we have to do something with our North American asset. It just cannot be left to just rent out the quantities which it needs to do. One thing is very clear to us: if we had a choice between expansion of capacity there versus I'm not speaking about debottleneck, expansion of capacity versus moving up the value chain. I think our choices are very clear. We have made that choice to move up the value chain. The study is complete. Initial study is complete. It is going to be the same set of chemicals we make everywhere. Sodium bicarbonate, sodium silicate, those sort of materials which will be made, which we have good expertise in. And the teams have put together the initial plan. We're also looking at what are the other options to move in that chain. But we'll come back to you with specifics by the fourth quarter of this year.
Great. Thank you so much and wish you all the best.
Thank you, Abhijit.
Thank you. The next question is from the line of Ritesh Gupta from Ambit Capital. Please go ahead. Ritesh,
Hi. Thanks for taking my question, sir. Just wanted to check on, you said that CapEx plan has been delayed. Was it for soda ash as well, or did you say that soda ash is also delayed there in the India business?
Yeah, I think that's right. The postponement, we've actually accelerated the capex for all which is needed for the nutrition business. So that is moving as per schedule. In fact, we were constrained more by availability of labor. While John gave financials, the entire project teams had left the site. We are getting them back on stream. So we have lost about 3 months of execution time on the nutrition side. As far as the soda ash is concerned, certainly both in India and in US, the debottlenecking which had to happen in US through the implementation of the 13th dryer has been put on hold. And we will relook at that when we come to the fourth quarter. As far as Mithapur debottlenecking is concerned, that is not on hold. In fact, there we have said that we should catch up going forward. All the approvals, all the elements are in place, and it's a delay which is a combination of us trying to conserve cash and at the same time also non-availability of labor. Both both these constraints are now out of the way, with near normalcy coming up in terms of volumes by the September end. We do expect that we will gather pace. But I would acknowledge that in some cases we've lost 3 months, in some cases we lost about 5 to 6 months of time.
Understood. And then just on the stakes that you have on the balance sheet into the Tata Group companies and including Tata Sons, is there any way you can monetize it at some point in time, or is there any thought process, because now you have your own capex plans as well? Is it a possibility that you can? I mean, some of them are listed, some of them are not. So any comments there from John or from you on how can you ever monetize it, given that it's a group company stake?
I think we have, if you take our balance sheet 5 years ago and when you look at the balance sheet today, or even 2 years ago and look at it today, it is fair to say that the monetization has happened. If you look at the entire acquisition of the US asset happened because we actually monetized the TCS shares to pay for the equity, which we had to put equity into that business. It was, of course, a leveraged buyout. But whatever equity we put in the business came through TCS share sale at that point of time. If you look at the current cash holding in the company, a large part of that also is the monetization of Tata Global Beverages shares which we own. So the group has been bringing that down. Currently, if you see, the biggest chunk which we own is of Titan shares, which I think is something which everybody is looking at. And if there is an opportunity, if there is a need, I think all these things are addressed. But it has been calibrated and moving in the right way from the group perspective. And we are today sitting on cash. We are deploying all the cash we have. So that I would only say, look to the history of what has happened. That will tell you that will be the guide to you about the future.
And anything on the Tata Sons stake? I mean, can that be monetized at any point in time? I mean, I know
I have read the reports as much as you have, and I think we can only say that how much we own is publicly known, and I think it's about 2.5%. John, am I right?
Sorry, looking, yeah, 2.53, yeah.
Around 2.5%. I think you can accurately check that, but that's what we have, and there are other group companies also which we have. So Tata Projects and various other entities, but they all fall in the same bucket. I think the intent is to deploy these over a period of time, and that will be deployed. And to be fair, all these investments which the company holds have also strengthened the balance sheet rather than anything else.
Mr. Gupta, request you to join the question queue for any follow-up, as we have several participants waiting for your turn. Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Thank you, sir, for taking my question. I joined a little bit late. I saw that your India volumes Q2 to Q2 have more or less normalized. I think it was 151 against 154 or something like that. But I wanted to know, how has the pricing behaved to you? Because this certainly looked better than one of your other listed competitor in terms of the volume recovery. But I wanted to know the pricing trend, in this quarter, as well as the outlook for prices in India going forward on the soda ash business.
So just to, we had already highlighted the pricing pressure was there in Q1, Q2, but I think the pricing pressure is coming off because of ADD being imposed. So it is not an internal issue, it is basically an external event, and Zarir has already explained as that gets notified. The normal trend has been there's a tightening in the pricing regime, which we have seen in the past, which is what which is what the expectation of everybody is. As far as the volumes are concerned, Indian volumes are back. Our constraint has been mostly our internal operations. We have reported already that we have taken 11 crore hit on the loss of material due to heavy rains, and there is additional damage which has happened, which we have claimed for insurance. And that broadly explains the issue, why there was a bit of a pressure on volume. The volume pressure was not from market, but from our own operations.
Okay, but if the ADD does not come, then excluding the ADD, what is the outlook for the pricing going forward?
So I think
overall, let me give you a broad guide.
Yeah.
In any product like this, as volumes come back, the pricing comes back.
Right.
And if you were to ask me, is the volume coming back? Yes, it is coming back. And the April-June quarter was the worst period. July, September is better. October to December is looking even better. And we expect by the time we get to quarter 4, things should tend towards normalcy across the globe, barring few places here and there. And as you know, this market is getting again very close to balanced, and it will tend to move in that way going forward. So by the time you hit middle of next year, the market should be tightening up if this trend continues. That's all I can say. Beyond that, we don't have any indicator. So it is improving, and the best indicator of price improvement is actually the volume improvement.
Understood, sir. Thanks a lot and all the best for the coming quarters.
Thank you. The next question is from the line of Tejas Sheth from Nippon India AMC. Please go ahead.
Yeah, good afternoon. Any supply side oversupply are you seeing in the at the global level over next 2-3 years per se, which can curb the realization even if the demand recovers?
A very good question. In fact, pre-COVID, our fear was supply. Our fear was not demand, because a lot of projects had been announced and about 4 to 5 million tons was in pipeline. What COVID has done is it has completely stopped everybody dead on their tracks. I'm also very sure these are very high capital projects, people conserving cash. These probably now are put in, they're probably going to take some time before they can get to see that they're moving forward, both from strategy perspective, also from financing perspective. So I think this should play out in the medium term to the benefit of the industry.
Okay. On the input cost, sorry if I'm repeating, on the input cost, can you just elaborate how you see that panning out in the near term as well as on the medium term, and the gross margin pressure is only a factor of lower realization, or there's some input cost connected?
See, in India, if you look at it, there are two one-offs, which is the 11 and 14, 11 crore on account of the kind of material losses we've had. It's not just material loss, there is also efficiency loss which happens when material is wet, you need more steam more energy to dry it and all that. So I think those are the impacts we had because of that heavy rain which happened because of the depression in Arabian Sea, which is a one-off event. It's happened after 7 years now. It doesn't happen every year. The other one-off point is also that there's a 14 crore hit on gratuity, which is a one-time hit we had to take on the back of merging of DA and basic in one of our sites, and that is an HR call because it helps us in the long run with lower impact on cost structure. But it is a one-time hit on the P&L, which is a gratuity valuation process.
No, I was more alluding to the input cost, sorry, at the gross margin level.
I'm covering the ground.
Sorry.
As far as the input costs are concerned, the biggest element of input cost in this business is energy. And broadly speaking, India is on coal, and that energy prices have mostly tended to be stable and have not moved up. But world over, I think the combination we have in UK and USA is also a bit of gas, and the gas prices have tended to be slightly benign in US, and in UK they've tended to be more or less flat. So we expect that trend to continue. Magadi is on HFO, and HFO prices have been down. Of course, our prices come down a little bit more slowly than the market rate comes down because we are hedged, And I think the hedging is good because we at least don't have the spikes in the business. But that's broadly the situation. So energy cost, which is the biggest chunk of the cost, is tending to hold or becoming benign. The other big cost is all fixed cost, operational cost. And I think on that, we have projects running to cut fixed cost out of the way, which should hold us very good next year and also during the second half of this year.
Okay, so with realization recovering, which may happen, let's say 2-3 quarters down the line, the gross margin too will normalize to the levels which we see in better part of FY20.
That's the expectation we have, and the expectation also is in the medium term it is good for the business because all the capacities which were announced are all now off the table.
Okay. Thank you very much.
Thank you. The next question is on the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity. So in terms of the current inventory in India and in global system, any thoughts on this, and how have the imports shaped up for the Indian market? Thank you.
Larry, you want to address this?
Sure. Could you just repeat the part of your question?
It's on the inventory, Larry. Inventory.
Okay, on inventory. So inventory, which was at record high levels, let's say in period of March and April, especially built up in China, has now come back to almost its normal level. So I think Chinese inventory had gone up to a level of almost 1.8 million tons, which is huge, but they also have the capacity to store that kind of volumes. But today, we believe that that inventory level has probably moderated down to about 750,000 tons, maybe even lower than that. And I think plants there have taken the opportunity to go in for extended outages, maintenance outages. So Chinese domestic supply-demand position has become rather tight and caused a sharp spike in Chinese domestic pricing. Chinese domestic prices have gone up by almost $30-$35 a ton, and part of it has flowed back into the Chinese export market as well. In India, inventory levels are back to normal. I don't think any of the producers are holding large stocks. And same can be said about the US market as well, where most producers today are producing to meet market demand, just like we are. As far as India imports are concerned, those have also moderated down. They were low during the pandemic, obviously, because of supply chain issues and port closures. When the ports opened up, a little bit of the pipeline started being refilled again. I think they're back to normal levels as far as imports are concerned. And I think with the notification of an anti-dumping duty, imports should significantly reduce.
Thanks for that. So the second question is in terms of capacity. So just now you indicated that Chinese capacities are operating probably at reduced rate or the extended shutdowns. So any other feelers from other geography on the same, and the capacities which were currently under expansion phase, so how much of those capacities probably will come online in 1 or 2 years, maybe brownfield expansions or greenfield expansion? You already talked about the 4 or 5 million tons, which was under planning stage, probably currently is on hold and will come back sometimes later. Thank you.
So I think we spoke of that. I think pre-pandemic there was very little brownfield debottlenecking going on. Most of the announcements were for large greenfield investments, primarily in North America and in China. The North American greenfield, I think, very sensibly, producers have possibly pushed that out by at least 4 to 5 years because those were large expansions and also requiring large capex investments. And I think, given current conditions, it seems unlikely that those would come up and be available in the market before 4 or 5 years. In China, there was only one major capacity expansion that had been announced, Inner Mongolia of natural soda ash. That also has been delayed. China, in fact, might see a reversal. We might actually see capacity coming off there permanently. There's about, in our estimate, 3.5 to 4.5 million tons of Chinese capacity that's at risk, primarily subscale plants and plants that are facing increased environmental scrutiny and regulation. These are plants that are possibly also located in urban areas, which will be asked to relocate. And rather than relocate, we believe that they might actually shutter permanently. Europe has seen no capacity announcements being made, and unlikely that they will be made. And in India, there were some debottlenecks that were in progress. I think those debottlenecking activities finished actually prior to the health crisis. So really nothing that's on the horizon for the next 2 to 3 years.
Thanks a lot.
Just to add to what Zari said, in our view, I think the market will not have issue from supply side, and as demand corrects itself, I think this market is well positioned now. I think our view is that this health issue and this whole shakeout which happened is actually playing out for better of the industry.
Thanks a lot and best of luck, sir.
Thank you. The next question is from the line of Padmaraju Mati from SB Life Insurance. Please go ahead.
Sir, thank you for taking my question. My question is specific to the nutraceuticals business, sir. Since you said you are awaiting approvals from pharma and food companies, so any timelines we are expecting for getting this sort of approvals?
I think we were slowed down by the pandemic. These teams could not visit, and they have since done the first line of audit and have given certain changes to be done, which is underway. So we will go back to them for reassessment during this quarter. Hopefully, it should happen very soon. We are pretty much very close to it getting done.
Okay, sir. Thank you.
Thank you. The next question is from the line of Dhavan Shah from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So I have a question on the soda ash business for India. So if I look at on quarter basis, the realization for soda ash from India was around 45,850 rupee per ton in quarter 1-21, which came down to around 39,755 rupee per ton. And you mentioned that because of flooding issue, there was some, the sales impact in terms of the cement volumes. So as you guys, include the cement revenue into the basic chem segment, so would it be possible to share that number for quarter 1 and quarter 2 from cement business and also in the quarter 2 FY20?
Sorry, John, you want to clarify? I didn't understand.
This number seemed a little off, but maybe John or Stephen.
Because I think all your numbers are a little off because I could not understand. We don't have such high realization. It's John, you want to clarify or?
Yes, so I need to check on that number because it doesn't sound right at all. But let's look at it properly and we'll come back. And if there's any commentary, we'll make it on the transcript itself.
Okay. So secondly, about the silica business. So you mentioned that there will be a capacity announcement by around 5x. So what is the the realization from that business, and what kind of top line do you foresee maybe within 2 to 3 years from this silica segment?
Yeah, we had already said that these segments play out in a asset turnover ratio of approximately 1.5 to 2. That's what we should expect, and that is at the normalized utilization and the capex fully getting deployed. So it will trend towards that. Okay.
And in terms of the CWIP, around 940 odd crore CWIP is there. So can you share it among the segments? I mean, this how much is for soda ash and the other capacity announcements, capex announcement, what you have done? So can you share it among the segmental breakup?
It will broadly be within the two segments which we have, which is nutrition and performance material. And I think, John, do you have a split, anything specific, site-wise or something?
No, the capex this quarter has generally been sitting within the basic chemistry products business. So that's where we are.
Yeah. I think
the major capex, the major capex was spent in the nutritional and HDS was really acquisition capex or development capex, which was all completed effectively last year. So there's no more. The capex coming through this year is going to be, as I said earlier, focused on the salt side, and that certainly was the first part of the year. Then it will spread back out towards the bicarbonate and soda ash and other processes later on in the year. But it's going to be sitting within the BCP business or the performance business sector you're seeing in the segment analysis.
Yeah. And I think as we start reporting by the new vertical segments, you will get that split much more sharper. We are intending to do that at some point of time. At this point, it's all mixed up. Some is lying in specialty, something is lying in basic chemistry. It's all not giving clarity. I think that will be clearer.
Thank you, Mr. Shah. Requested to join the question queue for any follow-up. The next question is from the line of Harsh Bhatia from MK Global. Please go ahead.
Yeah, thanks for the opportunity.
Sorry, Harsh, your audio is breaking, Harsh.
Yeah, is it audible now?
Slightly better. Please go ahead.
Yeah, on the domestic front for both India and US business, Q-on-Q the volumes have improved, so that is really good to see. Just to understand proportionately, where is this improving demand coming from which downstream industries? And is it any different from the US market and the India market, or are we seeing the same segments recover at a faster pace?
I think both markets are seeing all the sectors getting towards normalcy. I want to tell you that in US, for example, the auto sales last 2 months were the highest we have seen. So I think the sectors are picking up, and because of that, their supply base is also getting back on stream. What is still not fully clear in terms of end user segment is the construction segment. That's the only one which is a bit of a slow in terms of the recovery, but otherwise all other sectors are slowly getting back to where they ought to be. So we haven't seen any trend which is any different anywhere. This has been the trend right across every part of the world, including China, US, India. The trend has been very, very similar. Consumer comes in first, immediately following that is auto, and the last to come on stream. So when I say consumer, for example, it is both the soda ash used for detergent and the container glass, because containers go into consumer, and then next coming on stream is auto sector, and last is construction, and it's following the same trend.
Right, that's really helpful. Next question would be on the ethanol plant for soda ash and salt. Last quarter we had indicated that 6 billion is already done, and the remaining 18 billion will be done by FY23. So the plan stays the same, and how much have you undertaken in this current quarter?
So John, you want to clarify specifics on this? Nothing has changed on that plan. I think it's still on stream because bulk of it is also for the nutrition and salt and bicarb, and a small portion was towards soda ash. So John, you want to clarify?
Yeah, Mukund, as I said earlier, we had capex of 127 crores in a quarter. I'd say about 110 of that is all sitting within the BCP business unit, so really admittable. And for the half year, I'd say about 210 of the 232 is going to be BCP as well.
Sure. Thank you so much.
Thank you. The next question is from the line of Ramesh from Nirmal Bang. Please go ahead.
Good morning, everyone. Thank you very much. Are you able to hear me?
Yeah.
Yeah. So, if you look at the US business, we continue to see losses at equity level and EBITDA has come down.
Hello? Yeah, the audio is not clear from your line, Ramesh.
Just hold on. Is it better now?
Yeah, please go ahead.
Yeah. So I just want to understand in terms of the performance of the US, what are the reasons why the EBITDA was down and below the line? Why was there a loss? Because after we had a reversal of finance charges. So is this loss in spite of that, or are those adjustments still to be reflected down to the US?
Zari, you want to address this? The way I understood the question was specific to US. What is the reason why EBITDA is down? One is, I think, volume, because the fixed costs are, it's a high fixed cost business in any case in US. The break-even points are high. As that number is, as you move further up, the number as volume comes back, the margins come back. And as Zari has said, the volumes have been impacted mainly on exports. And secondly, I think the pricing in export also has been weak in the market, and that comes back when the volume comes back. It's all back to volume. As volume picks up, everything picks up. So you want to add to that, Zari?
No, Mukund, I think Mukund is absolutely right. It's really a volume game, and the effect of volume on fixed costs and also on pricing, specifically pricing in the export market, which was weak as could be expected. But we do believe, as we've mentioned earlier on the call, that trends are certainly looking positive today. So,
so if I take that a step further, possible to share what is the volume in the US just to understand in terms of once the volumes come around, what will be the operating leverage benefit to the US P&L?
I'm really sorry, but your audio is extremely muffled. Perhaps if you're using a headset, if you could.
Yeah, or Ramesh, maybe we could request you to, join back when you're in a network area because the audio is not clear.
Hear me? Hello?
No, Ramesh, it's still the same. Maybe request you to join the queue for, and rejoin the call, please. Thank you. We'll move to the next question. That is from the line of Hari Shyam Sundar from Franklin Templeton. Please go ahead.
Yeah, good afternoon. So my question is about salt versus soda ash production, and I wanted to understand what is the amount of flex which is there between the production of salt and soda ash. Could you quantify this in terms of range of output?
Sorry, could you repeat the question? I couldn't understand the specific.
My question is about, you mentioned that there is some flex between the salt and soda ash in terms of the manufacturing. Could you quantify what is the range of output in which there is a flexibility?
Yeah, I think it's mainly about how much of where do we use our energy and where do we use our drying, and I think the flex would be about maximum 5% here and there, but 5% is a lot when you talk about 1 million tons.
Understood. Right. My second question was on the margins itself, which are reported for the basic chemistry in India. Do you expect the margins to return to, what's the closer to 28 to 30% in the coming quarter?
So I think I would just add an S to that called coming quarters, because I think it will trend towards that and it will settle somewhere close to it by the time we are completely out of this difficult situation we've navigated. The good news is volume is back. The second good news is the pricing power is seeming to come back. So I think both these augur well. I don't want to pinpoint by saying it will come in the third quarter or fourth quarter, but it's somewhere in that range it should start to get to that point.
Sure, thank you.
Thank you. The next question is from the line of Hansal Thakkar from Lalkar Securities. Please go ahead.
Yeah, hi sir. On your press release, you've made a notation that this quarter you've achieved 3 significant patents. Can you throw some light on that?
All of them are in the area of nutrition and the materials business. The specifics I think it's better that we disclose it properly at the point when there is also a business opportunity coming out of them. Yeah.
Okay. And just some more of an ambition statement. I'm just trying to understand if the nutritional segment essentially continues to be chemicals, or we have consumer aspirations in that as well.
No, we are supplying to brands. So whether we like it or not, if you really look at our portfolio today, I think the portfolio in nutrition science is fundamentally going to consumer companies. It is Tata Consumer. It is going to all the food companies in India. All these companies are customers. They all make branded food. They all need B2B salt. Some of them brand it further and sell in the market. Some of them use it in their production process. And fundamentally, it's going into that segment. Bicarbonate also goes to the food companies because they add it to their food products and sell it. So these are food ingredients, even SOS, GOS, nutraceuticals, vitamins, and all the complementary products and premixes we give all go to these companies, whether it be the milk companies, whether it be biscuit companies, whether it be various other food companies. They are our key customers. So we are not getting into brand, but our products go into brands. And we have all the marquee brands as our customers. So, and they have a very steady demand pull from the market, and it grows steadily every year. If you look at our even performance material within India, a lot of it goes into detergents, which also is brands. So I think that is again a very steady growth segment. The segment which has been impacted in this pandemic has been mostly the one which has gone into flat glass. Container glass again is fairly steady because that also goes and supports brands. So if you say that, are you going to get into brand? No. Are you the people who are behind the brand, every successful brand? We are with almost every successful brand.
Thank you. The next question is on the line of Hemang Khanna from Kotak Securities. Please go ahead. Hemang, your line is unmuted. Please go ahead with the question.
Hi, am I audible now?
Yes.
Yeah, thanks.
Yes.
Thank you for taking my question. I just had one question regarding the basic chemistry segment. When we look at the segment as a whole, for the second half of this year, how do you see the margins moving? Because we came from, obviously 1Q was impacted at about 7%. We've recovered to about 10% in this quarter. Over the next half of this year and probably into the next year as well, do you see us, coming back to that 17% kind of margin which we did in FY20, and just your views on how the recovery will be for the second half of this year?
So I can only say it will be on the road to recovery. I can't pinpoint. It's very unfair for me to do that, but we are all hoping it's faster than being slower. The market signs are positive.
Sure. So basically we can, going forward, at least into the next
at some point, it will tend to that same number because that's a stable number for those businesses.
Sure. Okay. Thank you so much.
Thank you. Ladies and gentlemen, that would be the last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you, everyone. I think all I wanted to say is that just to use the IPL parlance, we had the initial overs, which ball was swinging a lot, and we really had to navigate very hard. We have now entered the middle overs, and I think here the basic act is to keep it steady, keep it going, not do too many things, and keep the ship steady. And we know that the end of the game is coming very soon, and post that I think it will be a steady run for all of us because end of this difficult period of pandemic is the beginning of the end. And as far as our strategy is concerned, that remains pretty much on track, that we are going to be building this business with more specialty portfolio across our all verticals, the performance material, which is soda ash and silica, and the nutrition science, which is salt, bicarb, the nutraceuticals and natural extracts, and agri-science. And all these verticals the investments are ongoing, and the growth journey is intact. albeit a bit of delay of 6 months or so, 3 to 6 months. And we remain extremely confident, especially on the back of the steady bounce we've seen in the economy and outlook around the world, and also the fact that the markets are and the medical fraternity is taking control of this difficult period, and they are over the hump, to say, in terms of managing the crisis. And we continue to remain fully confident that as we come out of this, even the energy transition portfolio, which has seen a slowdown, will also come back with full energy, mainly on back of the fact that the shift towards renewable and the need to store energy is a need which is not going to go away. And we are confident of that vertical too, albeit it is in a bit of a slow start than what we would have anticipated. I thank you all for your confidence and your support, and we remain committed to our goal of moving forward in this direction with this company. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Tata Chemicals Limited, that concludes today's call. Thank you all for joining us, and you may now disconnect your lines.